Hello and welcome to this video on monetary policy, a concept that helps us understand how the central bank can influence the economy. In this video, we will learn what monetary policy is, how it works, and why it matters. Monetary policy is the set of actions taken by the central bank to control the money supply and interest rates in the economy. The money supply is the total amount of money available in the economy, such as cash, coins, and bank deposits. Interest rates are the percentage of the principal amount that a lender charges a borrower for the use of money. The central bank can use various tools to implement monetary policy, such as open market operations, reserve requirements, discount rate, etc. Open market operations are the buying and selling of government securities by the central bank in the open market. Reserve requirements are the minimum percentage of deposits that banks must hold as reserves at the central bank. Discount rate is the interest rate that the central bank charges banks for short-term loans. The main objective of monetary policy is to achieve price stability and low inflation. Inflation is the general increase in the prices of goods and services in an economy over time. Inflation reduces the purchasing power of money and erodes its value. The central bank usually sets an inflation target and adjusts its policy rate accordingly. The policy rate is the interest rate that influences other interest rates in the economy. Monetary policy can be expansionary or contractionary depending on whether the central bank wants to stimulate or slow down economic growth. Expansionary monetary policy means increasing the money supply or lowering interest rates to boost aggregate demand and economic activity. For example, during a recession, the central bank may buy government securities or lower its policy rate to encourage more spending and borrowing by consumers and businesses. Contractionary monetary policy means decreasing the money supply or raising interest rates to reduce aggregate demand and economic activity. For example, during an inflationary boom, the central bank may sell government securities or raise its policy rate to discourage excessive spending and borrowing by consumers and businesses. Monetary policy is important because it affects various aspects of economic performance and well-being. Monetary policy affects how much people save and invest, how much businesses borrow and produce, how much governments spend and borrow, how much consumers spend and borrow, etc. Monetary policy also affects the exchange rate and the balance of payments between countries. To summarize, monetary policy is the set of actions taken by the central bank to control the money supply and interest rates in the economy. Monetary policy aims to achieve price stability and low inflation. Monetary policy can be expansionary or contractionary depending on whether the central bank wants to stimulate or slow down economic growth. Thank you for watching this video on monetary policy. I hope you learned something new and useful. If you have any questions or comments, please leave them below. See you next time.